Hi everyone, welcome back to Demand Decoded. Thanks for tuning in and taking the time to join us today. And today's a really extremely exciting episode. We're joined by Chris Walker to decode effective demand generation. I'm sure most of you have heard of Chris already for a bunch of reasons. It might have been through LinkedIn, the Revenue Vitals podcast, even Demand Gen Live back in the day. Let's throw it back. There was some good times. Or, the work he's done at his companies, Refine Labs, and most recently, Paceto. So, yeah, Chris, it's really great to have you here. I've been following you for about 3 years now. I've learned a lot in the process. Actually, firstly, thank you for sharing your insights with the world and me and helping us to all be better marketers. So, yeah, how are you doing today?
Yeah, thanks for following. I was getting pumped up with the intro music as we were going on live here. So I am fired up. For those of you on live, thanks for joining us. We're going to get into some cool topics and I'm ready to do it.
I'm glad you like the intro music. Yeah, we're pretty happy with that. As Dan said, thank you so much for coming on, because you've been a very big figure in our conversations over the years about what is effective marketing, and in particular, the evolution of what I think of as inbound, which has got some real merits and strengths, but not necessarily the same way now that it did, or perhaps ever had. So as a bit of a backdrop to this, we were discussing before coming live, the agency that I founded with my co-founder Sean has always been focused on creating really valuable, reliable results for customers, and it didn't take long for that to become pipeline, the ultimate measure of success for marketing being measurable in terms of revenue and pipeline. And we've been doing some form of inbound marketing for quite a long time: content creation, SEO, website UX, and of course those other things that are synonymous with it: lead nurturing, lead scoring. But it didn't take long to see that inbound wasn't working the way that it was described to work. Leads weren't tending to buy from us. Lead nurturing didn't turn ebook downloads into customers over the space of 3 weeks. Lead scoring didn't make more people want to buy what we were selling, and calling them didn't have any great impact or result. But people still bought from us, but they appeared anonymously at the very end of their decision-making process to stick their hand in the air and say, "Hi, I'm interested in what you do and I'm ready to talk about buying it." And that disconnect between those two sets of data, for me, led me on a journey to evolve our approach to inbound and the focus of the agency. So I've seen over the years a lot of similarities and consistencies between the story you've been telling online and the data that we saw. So it's really great to have you here. And to make today's discussion and the things that people see from you in the future, now that they're going to start following you after watching this, as relevant and as understandable for them as possible, I'd like to go back, if you don't mind, briefly to the beginning. The things that you saw, the observations, the learnings, and the shocks that you had when you first started to realize that the B2B playbook, as it was so woefully ineffective. What were you doing and what were you seeing when you started on this journey?
So let's talk about the first 4 years of my career. I effectively worked as a consultant inside of a large British holdings company called Halma Holdings, one of the few companies that have been able to deliver a positive 10% EBITDA margin for more than 20 years, traded publicly on the London Stock Exchange. What I would do at those companies, the subsidiaries of that holdings company, would be go in there for 6 to 12 months. The company would have a problem that they had sort of scoped out for me to solve. Typically what would happen is I would enter the company, be there for 2 or 3 months and learn and recognize that there's a different, more important problem or a larger opportunity for me to solve than what they had originally spec'd out. Mm-hmm. And I did those projects at 6 different B2B companies that range from $10 million to $150 million in revenue for the first 4 years of my career. I was inside of executive meetings. I was understanding what KPIs. I was working with the business development team. I was in the field. I was building trade show booths. I would sit in the trade show booths and understand how much we spent on them, and then look at how many conversations we had and try and track the outcome. I would hear all the feedback from the sales team. Marketing isn't delivering anything. These webinar leads and these trade show leads suck. Blah, 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 blah. And you could, and at the same time, spending a lot of time in product management and product marketing and understanding customers, like a very foundational part of my career. And you could understand and see that the way that customers want to buy stuff and how they buy stuff is changing fundamentally. And I was able to see that very early in my career, the disconnect between the way that B2B companies were trying to sell and the way that they made investments in sales and marketing, compared to the way that the customers were evolving and the way that B2B businesses buy. Fast forward to the next sort of 4 years of my career, I have some foundational knowledge, I have some maturity, I have some things like that. I worked at my first venture funded company. They had 50 field sales reps. They had 3 people in marketing. They invested $2.5 million a year in marketing and more than $25 million in sales.
Mm-hmm.
So market budget ratio, 90% of the go-to-market budget going to sales, 10% going to marketing. That field sales team was highly inefficient, mostly didn't generate net new business, but was basically hitting their quota through expanding current customers. That train runs out of the station at some point. At some point, you need to acquire net new customers to have room for additional expansion. And they just didn't have a good way to acquire net new customers. And what was it? We had 4 SDRs in there banging the phone, setting meetings for sales reps. The sales reps would fly or drive, sometimes fly, to go to a first meeting with a customer set by an SDR, win those meetings at 4%. That means we got to take 25 flights, take 25 drives, do 25 things to have one active opportunity that's going to close per rep. And when you look at the metrics like sales velocity and net new customer acquisition cost and the balance between the sales and marketing budget and how long our sales cycle lengths were compared to what the ACV and the annual deal size was, that it was clear that the go-to-market engine just wasn't performing at a level that's needed for the business to scale and eventually IPO. And so that company wanted me to manage a segment of the business. Within 3 months, I did the exact same thing. I recognized, hey, this is a big issue. I've been in the field. I've talked to customers. I've visited 15 of our best customers. I've talked to thought leaders. Like, you think that we need to be over here. We need to build a digital demand strategy so our customers want to buy our stuff, so that they understand that our new innovative product is very different than the 30-year-old thing that they've been using that they got trained on in college in the 80s. And we need to be able to educate them through key opinion leader strategies, digital content, partnerships and collaborations with other vendors, in person, sort of like field events. Like, this isn't just a digital strategy, and figure out how to balance the investment of our ability to create demand, i.e. get our target customers to want to buy our stuff, and then convert that pipeline into revenue, i.e. having all the field sales team trained, operating, being able to close customers and help those customers execute a purchasing process, which is highly complex when you're selling into large hospitals. And so the value of a sales rep at that point is helping the customer navigate how to actually get the deal done, not trying to have a sales rep that doesn't understand medicine to try and educate the customer on why they should do this.
Yeah,
I think that should be handled in a different way. And so we executed that process over 2 years that I led, from a $2,500 test budget to run a Facebook ad in 2016, to spending $50,000 a month on Facebook and other digital channels 2 years later, delivering 10x or more in pipeline for every dollar that was spent on advertising. And to have the company go from 0% contribution of hand raisers on the website to revenue to 33% over a 2-year period of time, where hand raisers have significantly shorter sales cycles, significantly lower cost of acquisition, significantly higher win rates, and deliver significantly better sales productivity. At the same time, during that, I ran a lot of the common inbound plays. I ran the Facebook ad lead gen form. I collected qualified people that go to qualified accounts. I nurtured them through email sequences. We had SDRs follow up with them. You run the exact playbook that was published on the blogs back then. And if you were actually focused on the right things, is our sales team giving good feedback about the meetings that they're having? Are they converting these into pipeline? That type of stuff. If you looked at that stuff instead of that just a blanket MQL, someone downloaded our form or somebody opened our email, then you would clearly see that the common inbound model in 2016-17 was failing companies. That was the beginning of the end of that model. And the core rationale to that is that most inbound leads are not actually inbound. A hand raiser, you could consider a quote unquote inbound lead, although I don't even use that distinction anymore. Inbound has been a way to tag things that come from marketing as a way to defend the budget of marketing And we need to be looking at it from the buyer's perspective, not our internal departments. And so it's not inbound versus outbound. It's what did the customer do that triggered us to take an action? And then what was the outcome of those actions? And then when we collect enough data, we can know that certain things that customers do lead to great results and certain things that customers do lead to not great results for our sales team. And then we have to make an educated decision as a business of if we want to continue to follow up with our customers that do the signals that we know don't work. And so, yeah, that's a long-winded sort of way of story of how I got here. And then I started my first company, Refine Labs, in 2019 off of some of those insights, which is the leading demand gen agency for B2B, high growth B2B companies right now. And I, was the CEO and founder of that company for the first 5 years of its existence, and recently promoted my business partner, Megan Bowen, to CEO as we, work to scale the company to the next level into a, multi 8-figure business.
Yeah. Okay. You've said a lot of interesting things in there. Now I need to try and pick on a few that I think will help our viewers and listeners adapt the way that we want them to. I think one of the most important things that you expressed there was that you saw inefficiency within sales, but identified its meaning to marketing. You saw that the behaviors that marketing were being advised on to do, measured on, and investing in were not producing positive sales outcomes. But it wasn't sales' fault per se. It's a mismatch between what's being generated and what's needed, informed by, crucially, buyer language and behavior, because it's how buyers buy that determines what's effective, right, from a marketing and sales perspective these days.
The largest sort of issue of why this stuff arises is the departmental level silos that drive incremental progress inside of the silo rather than looking at the entire system holistically. I was gifted and lucky to study electrical computer engineering. I understand how systems work. I know if you set some data over here, how downstream could affect the data over here, and you need to be able to know those things. But inside of a B2B company, they are not incentivized to look at those things. And there are very few people that actually look at that and understand, oh, our win rates are low. Oh, our SDR conversion rates are horrible. We need to fix marketing. Most people would not see that connection. And the core insight is that we need to be looking at our go-to-market engine holistically. Sure, we do want to try to improve our connect rates with SDRs from 0.3% to 0.4%. We do want to have our sales win rates increase. There are things that we can do in the micro, like sales training, negotiation training, using a tool to try and emulate the best practices of reps. We should and can do all of those things, but we need to be able to also elevate and look at the macro and say, what are the core issues in our entire go-to-market engine? And I started my first company on the core insight that marketing was the largest issue in B2B companies and largely unrecognized at that time. Most companies were like, we need to hire more SDRs. We need to fire our VP of sales and hire a chief revenue officer. People in 2018-19 couldn't tie it back to that marketing was the actual issue. And then over the past 5 years, my vision and my understanding of the market dynamics continue to evolve, where at this point, I believe the largest issue in B2B go-to-market is actually data. I believe that especially, growth stage, pre-IPO, mature companies, they have a great product. They have a large set of customers. They have, esteemed investors. They have incredibly smart, talented leaders and people that work at the company, yet they do not have the right data to get people aligned and make decisions quickly. They do not have confidence in the data, where easy decisions become hard, fast decisions become slow, and things that should be easy to get the exec C-level aligned to make a decision takes 6, 9, 12 months or more to make a fucking easy decision. And so that's what I'm working on at my new company, Paceto. I believe that if executives had the right data, that a lot of these decisions that take a long time and are hard to make would be super easy. And our goal is to be able to give the executive team and the underlying contributors that optimize campaigns, programs, and investments the appropriate data so that everyone in the go-to-market team is looking at the same set of data, can draw the same conclusions, and we can make decisions fast with confidence. Yeah. And it's, we've made a ton of progress when it comes to revenue operations and technology implementations and data from, when I started doing a lot of this stuff in 2016 to where we are now, there's been a lot of progress, and I don't want to discredit the progress that we've made. But if you look at it today, the average $100 million ARR company that I interact with, somewhere between 50 and 75% of their revenue, they have no idea where it came from. Sure, they produce some big, W-shaped or U-shaped visible attribution model that can say that all their programs work because it's able to take credit for any digital touch point that happened on any contact associated with any account that's attached to any opportunity, using the most generous attribution model that ever existed, built to prove the ROI of marketing and defend marketing budgets, not to push the organization forward and make strategic decisions. And so those are some of the core thoughts. I'm getting fired up about this. Those are some of the core thoughts I have.
Yeah, it's attribution, correlation rather than causation, right? In so many cases, and marketing. If we think about the origin of marketing, it was about communicating a proposition between one group of humans and another group of humans. That isn't something that you can necessarily measure in the way that performance marketing, tools, techniques, and results lead us to believe. I don't think. I'm interested to know, you've had exposure to a range of business types, sizes, but you've had the fortunate opportunity to look at a lot of large data sets with enterprises in particular. Quite a few of our listeners will be SMEs. I think there's a high level of consistency in terms of these findings across business sizes. I'm interested if you see it being the same, SME, enterprise, and also regionally. Have you noticed any differences or similarities, US versus Europe, for example?
So I believe that this is a nuanced question. I think there are some things that are consistent across the board and other things that might be a little bit different. So some things that are consistent across the board: the operating model, the KPIs that are used, and the general tools that are used, from, a 10-person or 20-person startup all the way to large companies. The way that they think about, we need an MQL, or now it's an MQA, and then we need to get an SQL, and we're going to have this assembly line where marketing delivers leads, and then SDRs call the leads, and then salespeople have to try and close all those shitty leads. That the model that companies use is almost entirely homogenous, built from the original model of Serious Decisions in 2004, which has now been re-architected to try and make it an ABM waterfall, which is causing companies huge problems in their data and their analytics, because those companies talk in theory and do not deliver in the actual implementation. So sure, you can look at this nice chart. It looks beautiful. You can put it in your PowerPoint to the executive team and the board. But then when it comes down to actually getting it done, so you can make that operationally efficient and actually run it inside of Salesforce with your big organization, that's where all those frameworks fall down. Now, a lot of the companies I interact with now tend to be more mature. We're talking, 30 million on the low end, billions of dollars of revenue on the high end. And the things that I've been surprised at as I interact with, I've probably personally consulted with 50 of those companies, CMOs, RevOps leaders, VPs of sales inside of those companies over the past 9 to 12 months. The things that consistently surprise me are, number one, that the companies that each individual department uses different metrics and different data and different properties to track the data, so that each individual department's able to, put their 120 slide QBR deck together and then level it up. And then when you look at all of them together, you realize all this data is conflicting. None of it makes sense. It looks like every department is working, yet our growth has declined for the past 4 quarters. And so you have departments that create analytics and data about how good they're doing, because all of the analytics are built bottom up to prove the ROI of a micro thing and a micro thing and a micro thing, and then level it up. That at some point we need to also have a tops down model, just like we do in finance, that forces some of these things to create consistency around how we look at the data, so we can actually make decisions. So number one, just been surprised the departmental level silos happen at those types of companies. I've been consistently surprised at how, for lack of a better word, how poorly the marketing investments are actually deployed and then scrutinized. That it's unbelievable that a company can spend $1 million a month on Google ads, mostly not be able to track it, have the measurable standpoint, get a 60-month advertising CAC payback on average, which means it's taking them 10 years or more to pay back the total cost of acquiring the customer through Google ads, and continue to spend that money every quarter. Like that blows me away. And that is not like a one-off example. That is a consistent pattern with companies that spend a lot on Google. They basically get hooked on the drug. It's like the fentanyl for B2B SaaS companies. And then they keep spending more on it regardless of the ROI. And then they get scared to pull back on it because they have no other means. They have no other ways to spend that amount of money without making a huge risk inside of the business. And so what happens is you just create this massive pressure on cost of acquisition and growth by not, scrutinizing and deploying marketing investments appropriately.
Yeah.
Another pattern, I'll just mention one more because I know you got a question here. Another pattern that I see is across the board is that companies when it comes to the marketing budget, do not allocate investments properly across the entire customer life cycle. Marketing budgets should be deployed to create demand, to capture intent of in-market buyers, to convert active pipeline and accelerate sales velocity for deals that sales is working, and to expand accounts and drive up NRR. There are 4 different core categories of the customer lifecycle where marketing budgets should be deployed. 85-90% of it goes to capture intent spent on Google, review sites, and other forms of performance marketing. And then 2% on demand creation, 3% on customer marketing with 1 headcount, a couple of field events that they do to create pipeline, a couple of dinners, and basically no investment anywhere except how do we get leads? Where does that come from? It comes from the measurement models. It comes from the way that companies scrutinize it. Why would a marketing team and a marketing leader deploy budget to convert pipeline for your sales team when they are only measured on pipeline creation? That pipeline has already been created. They have no incentive to do that, even though it is great for the company. It is great for the sales team. It's great for the marketing team. It's great for the customer. And we need to be able to shift the way that we incentivize not only marketing, but all the departments across the go-to-market to create KPIs that align the teams and drive the right behaviors and make sure that when we are deploying money that isn't working, that we can easily identify it. And I just don't think that we have a lot of those pieces in place right now. So those are some of the patterns that I've been seeing that I've been frankly surprised by.
Well, certainly from my perspective, working with the M and the E in SME, most of the time, I see incredible consistency with what you describe in the larger enterprises that you work with in terms of the return on investment or lack of it from a lot of what are highly revered, recommended, and what very strongly pushed activities. And also, well, the knowledge that if you can create a voluntary, freely opted in demo request, for example, the close rate potential of it is so much higher than spending money to generate 200 leads, nurture the hell out of them, call them, and try and get them in the pipeline that way. And for years now, we've shifted our energy and our attention all the way to that other goal. Do the things that indicate, can't always measure it directly, bring buyers into the pipeline.
I mean, like the way that B2B companies measure marketing I'm glad that you got there, but the way that B2B companies do it, don't incentivize any of those behaviors.
No, indeed.
They would rather the metrics would push people to rather get 200 shitty leads that never buy than 5 hand raisers where you're going to win 2 of those deals fast. And that is a mindset of the growth at all costs era. It's a mindset of the MQL waterfall that many companies still model their revenue against, where the assumption, the poor, wrong, incorrect assumption that drives a lot of wrong behaviors is that all leads are created equal. And furthermore, that all pipeline is created equal when there are dramatic 10 to 100x different conversion rates and win rates for different signals that I don't even use the term lead anymore, different signals that our buyers give us, and different types of pipeline can have 10, 20 point swings in win rates from the same stage that are clearly indicated based on how the company and the buyer came into the pipeline.
Yeah.
And so that is the core. The singular lead funnel is the core issue around why companies struggle with this, because it just says get this much volume at the top, doesn't distinguish between buying intent, doesn't distinguish across the win rates. It leads to massive issues in forecasting and planning and scale. That's why you see companies pump up MQLs watched companies try to go from 30,000 a year MQLs to 60,000 MQLs, and they make that jump and they get to 60,000 and they hit the exact same revenue they did the year before. Because the incremental 30,000 are mostly almost always trash.
Absolutely. I was always amused whenever I'd look at a lead scoring model and you'd find the one rule that had been slipped in by marketing to, 5x or 10x the MQL they were generating.
Yeah. That's so true.
It's nonsense if you've got to do it that way. We've had a brilliant run, and we've covered off a lot of the interesting topics we wanted to dive into. I'm just looking to you, Dan, to see where you want to go next.
Well, so I think, Chris, you've spoken a lot about wasted budget, and I'm big on the PPC wasted budget. I think I commented on your post the other day, we wasted it. But one area I'd like to dive into is where we actually see a lack of investment, where there should be more. And I'm interested to know if you see the same. So, do you agree that when it comes to websites, a pivotal and crucial component of a demand generation engine, that there is a lack and almost not a willingness to invest as much as businesses should in that area?
I'm going to go through other things that I think companies underinvest in generally. Let's cover the website first. I think that companies dramatically underinvest in the website. It's like their store. It's like having your storefront on like a backside street and not mowing the lawn, and the shutters on the windows are falling off. Metaphorically, of course, but that's basically what a lot of companies do with their website. Meanwhile, their website delivers $40 million a year in pipeline. And they're not going to spend $15,000 or $20,000 to make a massive improvement that could take that 40 to 50 million. And so companies really struggle with this concept between working dollars and non-working dollars, where they think that the only way to actually make impact is by adding more working dollars.
Right.
But the reality is, for a mature company, you might have 100,000 or more website visitors already on your website. Communicate your message properly, create a better conversion experience. Then after they actually fill out the form, make sure that we get them into a meeting and use best practices and just ways to improve the customer experience. I think there's generally an underinvestment in the website, part working dollars versus non-working dollars, partially because the website tends to be a marketing asset instead of a business asset.
Yes.
And we need to be thinking about our website as a business asset. It is undoubted that every single, no matter if it came from partner or you went cold called a bunch of people or any other thing, that any company that is going to buy your B2B product, multiple people from that company are going to land on your homepage. They're going to look at your customer stories. They're going to do those things. And we need to be able to understand that the website is a business asset, not a marketing asset. I'm actually even pushing against the idea that if a buyer comes to our website and says, I want a demo, why do we credit that to marketing? Why is it like that? The website is a business asset. The SDR still has to follow up with them. Sales still has to close them. It's a company win when a qualified customer comes to our website. It's a marketing win, but it's more importantly a company win. And I think the way that companies continue to divide departmental level credit as an easy way to scrutinize the investments drives a lot of these poor behaviors. We're actually evolving in the way that we look at this and taking out a lot of the departmental level silos from an analytics and an investment perspective. So stay tuned for more of the ways that we're thinking about that in hopes of solving this problem. Other places where I think companies dramatically underinvest, ops and data. I think that, you got a company that has 45 marketers and 60, quota carrying sales reps, and has 2 rev ops people, 2 marketing ops people, and they're just fulfilling tickets, not doing anything strategic because they just have to keep their head above water. Partially that is because the company has those people, potentially the wrong people in the wrong seat, and the people not doing the right type of work, but also it's just a dramatic underinvestment, again, working dollar quota carrying versus non-working dollar viewed as an expense. Companies dramatically underinvest in anything that doesn't get tracked by digital attribution. Point blank, that simple. If you didn't have that and you just listened to where do my customers learn, what do my customers want, and you delivered on that, the marketing mix in B2B companies would be 90 to 100% different, a complete 180. So that would be participated in communities, actual thought leadership, not hiring your marketing manager to make a PDF or outsourcing it to an agency, actually having leading thoughts for your industry that help executive level buyers make strategic decisions. Any type of organic social media, any type of paid social media that isn't directed toward a performance marketing lead gen funnel. You know, even when it comes down to like a lot of the stuff that I did way back in the day, which is a lot of like field marketing to accelerate pipeline. Like let's go get these 3 accounts that are in our funnel in the greater Atlanta area, and then let's get our 2 biggest promoters that use our product from the Atlanta area, and let's have a dinner with 12 people, and let's get these companies that are in stage 4 over the line. And again, like because of how a lot of companies use the metrics, marketing is not incentivized to deploy $15,000 on that dinner between travel and expenditures to be able to close those key deals. So I think that those types of things continue to be underinvested in. So yeah, those are a couple of the patterns that I see specific to the marketing budget. You could go and do almost the exact same thing in SDRs and sales if we wanted to, but companies have over investments and under investments in every single department. Part of it is because I've been challenging this a lot. If there are like big companies will then go out to a Gartner or a Gartner specifically and say, okay, if we are 100 million plus ARR software company, that we should spend 12% of revenue on marketing. And where does that benchmark originate from? It originates from CPG reoccurring revenue business models, not recurring revenue business models, which leads companies to dramatically overspend on marketing, which leads to huge inefficiencies. And if you actually put pressure on that and said, we should deploy the marketing investment commensurate with the results of net new business revenue for that investment, you would spend dramatically less on marketing and you get dramatically better ROI. And so I'm pushing against that piece as well. Companies and the people that work in those companies, no fault to them, I do this a lot myself as well, take benchmarks and data that do not have the context around why we're using them and then pull them into the wrong context. I'm pushing really hard against marketing dollars as a percentage of revenue in a recurring revenue model software business. I think it's a terribly inefficient way to decide how much to invest.
Yeah, you're nodding there, Dan. I wondered whether you were nodding about our
it was the data point, right?
Call.
Yeah, the benchmarks. We were literally talking about that the other day, weren't we? There was a report that was, it didn't explicitly say it was focused on SaaS, but we were trying to see if we could take any learnings from it for our own, service-led business. And we just thought, we can't really. Like, we really need to take this data with a pinch of salt, like for it to bear any meaning to us.
Yeah, because it was a SaaS as a business model has been so successful. People apply it to everything and anything nowadays, and actually there are stark differences between service businesses and software businesses delivered as a service. It feels like we desperately need some new, economic groundwork to be done to show us what the effective way to build a business is today.
Yeah, but the economic differences when it comes from a service business to a SaaS business in 2021 could have been, 20 to 100x difference. Are now, a normal software business right now is valued at 4 to 6x ARR, when before you could get 20 or 50x. And what happens when that happens? All of the behaviors that you do when you get a 20x revenue ARR multiple break when you have a 4x revenue multiple or a 5 or a 6. And so you have companies that will accept that they have to spend 24 months of MRR to be able to acquire a customer on Google just for the advertising spend. And then you put the marketing headcount and all the other marketing programs in, and all of a sudden it's 48 months. And then you put the sales and SDRs in, and all of a sudden you're close to 100 months to pay back the cost of getting one customer on Google. And that is just that's just not good. It's not going to work in a service business, but it's not going to work in any business. And so I think software companies are going to have to spend potentially close to a half decade, especially the larger ones, unwinding a lot of the bad stuff that was enabled by the massive revenue multiples. And perhaps the economy gets way better and the multiples go back and all the bad behavior continues. I'm not sure, and I'm not here to predict that. But as long as we have this pressure on revenue multiples, I don't think that SaaS will ever be back to the way it was in 2020, 2021. I just don't. And the competitive landscape and how AI is accelerating products and product parity. I think there's just there's too many forces happening that I don't think SaaS will ever get back to where it was at that point. Still, arguably one of the best business models, super high gross margins, although a lot of people are saying that many SaaS companies the assumption is 80-90% gross margin in a SaaS business. And many people are saying, given a lot of the commoditization and given the need for to be able to actually truly help customers be successful to drive retention and NRR, that we'll see gross margins come down in software businesses, especially with price pressure and product parity, a lot of different forces there. And that would be interesting to see as well. Like people predict, some of the people in the All In podcast suggesting that, potentially where we're going to land for SaaS multiples at the end will be 60-70% instead of 80-90. And that puts a lot of pressure on sales and marketing expenditures and the, research and development, the cash flow of the business and the financing requirements. So I think there's just a lot of interesting, important stuff happening in the space. I think that when we look back as business leaders and founders and CEOs, we will look at it and say it was a necessary, important part of the overall journey as an entrepreneur and a business leader. So that's some of the things that I'm seeing.
Yeah, I think the subject of multiples and funding and loss versus profit brings me on to something that's frequently kind of perplexed me, and that's outbound selling. I don't meet a lot of people that tell me they're just waiting for the right cold call to buy a product or a solution or a service. And to me, quite often when you scrutinize the concept of outbound on that basis, it kind of crumbles. But it's the backbone and the bread and butter of so many successful organizations, and it's vocally supported by a lot of people. What's your stance on outbound as a model? I know you've commented on the fact that it does generate revenue for the businesses that do it, but is it a sound investment, or are there problems with it?
I think that a lot of early mid-stage companies take advice from late-stage companies or the analyst firms that advise enterprise companies, right, where the advice that happens up at that level, sure, Salesforce probably has a great outbound engine. Everyone in the fucking world knows who they are. They have tons of customers. Yeah. And there's many brands that are like that. When we are at 20 million ARR, we cannot expect that what Salesforce is doing or what Snowflake is doing is the right decision for us. And so I think that is one of the major dichotomies about where you get your advice from. The move in outbound, I don't use the term outbound anymore because it implies that there's inbound that goes to marketing and there's outbound that goes to sales and SDRs to deliver credit. That is over. What we need to be looking at as a go-to-market team is we are doing signal-based outreach. Signal-based outreach. It doesn't matter where the fuck the signal came from. It does not matter. Was it an ebook download? Any type of touch point that you get from digital attribution in a first-party account signal on your website, user gems feeding you that your champion and a current customer moved to a new company, your VP of sales giving you a cold list of 20 accounts to call this week. Any of those are signals that then drive sales and SDRs to take action. And we need to look at this holistically as a go-to-market team. We need to be able to look at all the signals that are available. We need to look at the dynamics, the productivity, and the sales velocity of those signals. And then we need to make decisions about what signals do we want our customers what signals do we want to invest money to create because of that. Yeah. And I think that is the move that we need to make in go-to-market. What's happened specifically over the past 3 years, back in the day, companies would use a sourced model, which has a lot of flaws to it, especially when you look at it as department sourced. There's other ways to use a source model that doesn't tie back to department investments, but if you use a department source model, it forced you to deliver the credit to sales or marketing or SDRs, and then so $1 in revenue had to go to, and $1 in revenue downstream. Now, over the past 3 years, what companies have done is they've adopted an influence model where you can close $1 in revenue, but then 7 different budget line items can take credit for that same dollar.
Yeah.
And so what happens? Your go-to-market becomes incredibly bloated, incredibly inefficient. And when you look at the metrics, it looks like everything's working, but you know that it can't working because the business metrics don't add up. And that's why a lot of companies are struggling with how to actually have an efficient go-to-market is from that specific thing. Who pushed people to do that? Attribution vendors and ABM vendors. No fault to them. They have a story that they want to push in a market, and many things that they push in a market I agree with. But when it comes to the actual implementation and seeing the issues on the ground and solving the issues on the ground, they are not involved at that level. So they deliver advice that works in theory, it breaks down in practice. Their customers aren't able to do it, but they believe in the mission, so they carry forward. We're here to close that gap for companies, to provide an operational infrastructure for when you want to run an integrated go-to-market team, that you have the right data, you view it in the right way, and you can use it to make decisions across your entire go-to-market team. So those are some key points there.
Yeah, outbound is so interesting, and actually, I'm seeing some comments come in on outbound, so I'm glad you brought it up at the time, Phil. I'd like to dive in a bit deeper to the role of intent data, because Phil and I have this conversation all the time about intent data. I'm not sure we fully see where it fits, even in an outbound motion and also an inbound motion. I'd like to get your thoughts on where it fits in both, to be honest.
In demand gen.
Yeah, in demand gen, if it has a place and is effective.
Okay, so basically, you can use intent data that's account level. Let's say at account level intent data for this point in 2 different ways. You can use it to trigger marketing activities. You get some intent data. You assume that account is in market, so now you're going to run a display ad campaign to that account, right? So you can use it to trigger marketing actions, or you can use it to trigger signal-based outreach based on that intent signal that comes from some type of one-to-one communication. Those are the 2 ways that you can use it. The story about only market to the accounts that in market, I think, is entirely flawed. By the time that company is in market, they've most likely already selected their top 3 vendors. They're already evaluating those 3 vendors. If you're not on that list, you're in trouble. Yeah. You need to be marketing way before the account is in market. And ideally, you are the driver of why that account is going to buy your category, your product. And that's why they're in market. Therefore, you're going to almost guaranteed to be on that list. And if you're number 1, you're going to win a lot more. When it comes to outreach and capturing active in-market buyers, I think there is theoretically a place to use this. Have I seen a lot of companies report in their data and trackable, measurable things that it's entirely working for them? No. What the ABM vendors and intent data vendors try to do is try to prove that their MQA is better than an MQL. And they're good at proving that it's better than MQL, but it still doesn't evaluate the fact of, is this good enough to continue to run? It's only trying to prove it's better than the previous state, but the previous state's really bad. So it's not that hard to be better than that. Yeah. When you think about the intent data specifically, you have first party, second party, and third party intent data. Some vendors try to mash it all into one and give you a score and not tell you about the underlying data model, i.e. a black box that many people are requesting and changing vendors because they want a lot more transparency in what those signals are, and so they can measure and evaluate them. My hypothesis, unproven, one person's perspective, is that the first party intent data is really the only thing that's valuable. And even at that point, cool, IBM's on your website. What does that mean? Which of the 1,000, 2,000, or 10,000 director level plus people are you going to call? There could be 100 different buying centers inside of IBM. It almost means nothing. And I think there's a ton of false positive when it comes to intent data. So what? IBM was on your website. Could have just been some random person that saw your LinkedIn post and went to your blog and then left. And now all of a sudden, now you're on this wild goose chase to go try and find a buying center in IBM for no reason.
Yeah.
And so again, when it comes to this, the key is to look at all of the signals holistically, to track them holistically, and then make decisions based on data.
Yeah.
That's really the solution. And the main problem when it comes to outbound is that none of that data is tracked.
Yeah.
So they can't understand what signals are working and what signals aren't. Marketing's able to see what signals, but marketing is only delivering 30% of the signals. Maybe, so you got 70% of actions taken by sales that are largely untracked, which give you no data to optimize or make decisions and change. So I think those are some of the core points revolving outbound and intent data that I see today.
That's incredibly useful and broadly consistent, I think, with where we ended up on our side. And so important too to look at the whole buying journey, right? Like you say, showing an improvement between MQL and MQA may be very straightforward, but when you get down to pipeline level and closed won, that's where it really matters what kind of results you're getting. And it sounds like the best advice we can give to marketers, particularly those in SMEs that want to scale their business and scale their career, is like obsess over the pipeline part of the result, as well as the marketing metrics that you're convinced to measure ad infinitum. Because if you understand where deals are coming from, which ones close, which ones don't, what the sources of those intent were, then you are going to be in a much better place to drive an effective marketing program that grows your business rather than just spends marketing budget for questionable ROI.
The best marketing leaders out there, the most successful marketing leaders at the most successful companies, take the position of I own all pipeline. It doesn't matter where it came from, which then makes you as a CMO really care about how efficient the outbound process is. Really, the outreach processes makes you really care about what's happening in the partner motion, even if that rolls up to sales in your org. Yeah. It makes you take a view of all of the data and all of the different levers that you have to pull across the entire go-to-market to hit the targets that the business sets. And you still have a lot of marketing leaders that over there building their marketing influence report and not taking accountability for the whole thing, spending more time trying to prove or justify the investment rather than trying to figure out how are we going to make the investments that we deploy incredibly more effective to continue to grow the business next year. Just the analytics perspective in marketing just frustrates me a ton because most of the time is spent justifying, not improving. Yeah.
Like you said, that sort of top bottom up look at metrics and how we can improve them, as opposed to a top down look at results and what drives them and what correlates with the greatest success that we have as a business.
Think about when you're starting up a company, like at some point in the company life cycle, you're going to bring finance in-house, you're going to have a finance team. And when that finance team comes in, they have a standard structure of how they actually look at the data. Everybody in the company understands what it means. They have a balance sheet, they have GL codes, they have all these things. Yep. Yet in marketing and go-to-market and in RevOps particularly, we reinvent the wheel every time. Mm-hmm. Every single company just makes it up as they go. They rely on the talent and experience of one or two people and not leveraging the things that finance and software developers use SDKs all the time. They borrow code that someone else has already written that's proven and they build on top of it. And I just don't know why in go-to-market and data in those places that we don't have a core foundation that every company operates on, just like a P&L, which then and then you can build custom stuff and you can push that into BI and you can do whatever else you want after that. Instead, we have companies, marketing teams that spend a month putting together a 120 slide QBR deck where the paid search manager makes the paid search slides and the SEO manager makes the SEO slides. And the field marketing manager makes the stuff for the conferences and somebody else makes it for PR. And while everything's, sunny and rainbows in every single one of those types of decks, because that specific person's goal in that deck is to prove why their stuff is working the best, not to inform the company about how are we going to deploy investments to get a better return. And so I think just, yeah, like a lot of those areas about how, how the reports are built and why we're actually building them and where they come from. I think we need to really rethink those things. We have to get out of the game of justifying budget. We need to have standardized, objective metrics in our go-to-market that tell us clearly whether marketing is working or not, that tell us clearly whether SDRs are working or not, or better yet, what the spectrum of the performance is and what the return on those investments are, and if those are in an acceptable range to continue. And we need to be able to basically be able to look at that level instead of taking a month to do a deep dive and try and figure out whether marketing is working or not.
Yeah, yeah, agreed. I see something as well, which is there are so many platforms that you can take off the shelf, certainly while you're small and getting started, ready to scale, that can tell you all this end to end. But rather than implement a tool that gives you visibility all the way through the buying journey, there's a tendency to insert complexity for complexity's sake before you've even embraced the basics that a platform, a CRM with a marketing, tool set can offer you. And I find that companies, basically saying that technology is more than good enough today to tell us everything we need it to tell us.
Totally disagree. I couldn't disagree more.
Maybe, okay, now I hear where you're coming from. But I suppose what I'm saying is that still, it's not hard to have an end-to-end system as a baseline, as a basis on which to build the data and the reports that you need, and yet so many businesses still lack it, right?
The idea that you buy a tool and all of a sudden you understand the whole customer journey is total nonsense. You understand 3% of the customer journey in which that person had a digital trackable touch point with your business. Not all the time they spend with other vendors on other vendors' websites, with all of their peers in all of the places where you can't track it, which makes up, estimates here. I'm not some scientist. 90% of the buying journey that doesn't happen in a trackable event with your company. And it's nonsense. Sure, you can get a couple of things. And then another thing about the journey is assuming that the journey is linear, that because that touch point happened in the middle, that was really important or valuable, not understanding that buyers come in and out of market and it fluctuates. It's not linear. I think the entire way that we look at the quote unquote customer journey, I think we really need to challenge it. I think it leads to a lot of the wrong information. It definitely leads to a lot of the wrong behaviors. I watch companies justify their Google ad spend on first touch attribution of any contact attached to an opportunity. What does that incentivize you to do? Get as many trackable leads as you can to fill the database with people that don't want to buy. And then eventually down the road, you'll be able to take credit for them when that account closes because they work at that company. And so I think there's tons of flaws about how we perceive the customer journey, how we perceive the completeness of the measurement in the customer journey. Sure, we have some data. I bet we can use it for some purposes, but to think that we understand the whole thing is just wrong.
Yeah, completely agree. And I mean, we're big believers in the value of, for example, it's just the beginning, just the tip of the iceberg, but self-reported attribution is a great way to sort of divorce yourself from the drug that is performance-based attribution and start the process of learning what really drives your buyer. But I think where I'm coming from is, if there's a break in your systems between pipeline and everything else, like, that's fundamental. You really ought to get those systems connected so that marketing can see that information and be able to use it in their decision making and strategizing, right?
The biggest problem is that B2B companies try to use one tool to build a whole building. That's what they try to do. They try and force fit digital attribution, i.e. a hammer, into every single part of the customer journey, where part you should be using a screwdriver, another part you should be using a hammer, another part you should be using a jackhammer or a concrete mixer or something entirely different. But no, they're sitting there with a hammer trying to nail in something with one tool. That's the problem. That when we look at how are we creating demand, how are we getting our target accounts in market to buy, that trying to use a visible U-shaped model is the fucking stupidest idea ever to be able to measure that part of the process, because it doesn't measure most of the things that are effective there. Then when you look at how are we capturing intent, then W-shaped model, even better, just a, what we call a signal, a last touch model, would be a great way to measure how are we capturing in-market intent and getting it into pipeline. Then when we're trying to expand accounts, or whether we're trying to convert active pipeline, we're going to need other ways to measure that stuff. And the idea that we just take one tool and try and measure it across the whole customer lifecycle is everything that's wrong with marketing attribution today.
Yeah, I think that brings us nicely onto your new business. And I want to take this moment to an opportunity to for you to tell our viewers and our listeners about what Paceto is, compared to Refine Labs, and what was the catalyst for you choosing now to make this change, launch this venture, so we can understand that.
So the catalyst, the insight, is that for the 5 years that I ran Refine Labs, I noticed a clear pattern. The pattern was that the companies and CMOs that we worked with that were able to change the core KPIs of how they run their go-to-market were incredibly successful with us. And the ones that weren't, which led me to the conclusion that while originally I thought that if you solved for demand gen and marketing, that a lot of the other stuff downstream would solve itself, that assumption was incorrect or incomplete. That the actual root cause issue is that the executives do not have the right data to make what should be easy, obvious, fast decisions. Mm-hmm. That is the issue. And so on that insight, my company Refine Labs, it was also a very great time where picking up a lot of momentum. My business partner, Megan Bowen, is an incredible leader. The vision and the path of where we go with that company is very clear. And frankly, I think she'll be a better leader than me for that company at that stage. And what I'm really passionate about is solving this core problem of how do we fundamentally shift B2B go-to-market from the stale, outdated, theoretical that exists today and move it into, actionable, effective, customer-centric actions. And so that's effectively what we're doing at Paceto. If many people are familiar with the bow tie model from Winning by Design, when you see the bow tie, you're not over there thinking about this is an attribution tool. You're thinking about this is an operating model for how we're going to run and measure the core KPIs inside of our go-to-market. I'm not trying to compete with Winning by Design by any means, but we believe we have a better mousetrap when it comes to the customer acquisition workflow. About how you actually acquire customers and what are the core KPIs and things that you need to measure across that, and how do you structure the KPIs so that you could the departments inside of the go-to-market can operate in an integrated way, and so that are incentivized to do the things that are best for the company, not just best for their department. And so we have developed, a bow tie like model. It's an enhancement, I believe, of what Winning by Design created, which is a great solution, a great way of thinking. Then instead of, then we're building an integrated stack. So then you have, okay, these are the KPIs that we're going to measure. Then we have a unified pipeline architecture, an actual standardized way that you should structure your Salesforce or CRM instance. So you collect the 57 important data points that you need. 57 important data points that you need for every single interaction or signal in-market buyer sends you. Mm-hmm. And then we have a purpose-built software product that knows what those 57 core data points are, and those data points will evolve, that knows how to analyze all those data to present the metrics to executives, to answer key questions about the go-to-market that help allow them to make decisions fast. Then there are partners downstream that are going to manually put together the sales, or even, not even partners often. It's just the people inside of the company, the ops people have to put together and reinvent the wheel on the Salesforce data. And then the Salesforce data sucks. And then you have attribution vendors that try and attach on to bad data and manipulate that data to try and present some things. That we actually need a full stack solution from operating models, Salesforce infrastructure, and then the analytics behind it to create an actual change in the market. I recognize that there is a lot of inertia in the other direction for what we're working on. I have no interest in being an attribution vendor. I have a lot of interest in reading the data that attribution vendors produce, all the touch point data, and then representing that to a customer in the way that they can understand.
Mm.
I have a lot of interest in using attribution touch point data as one input. And then we also have 7 other core inputs of how we look at the data purely for KPIs, forecasting and modeling and making good decisions as a go-to-market. I'm not out here trying to be able to justify LinkedIn ads. It's just not anything that I'm interested in. It's actually the KPIs that are the problem inside of B2B companies. It's not attribution. Yeah. If the KPIs were measured in the appropriate way, it would clearly say that these things aren't working, which would then lead you in the direction of attribution to try and disprove that things are working, to try and identify what's not working instead of trying to prove that everything's working. We need to change the way that we look at the data. We need to start asking different questions. All of attribution is built to say all of these things are working, where we need to have the lens and be able to look at when the business metrics aren't working. We have to look at the data with the question, what isn't working? And it's just not a question that a lot of marketing leaders have been asked lately.
Yeah, agreed. Looking for the things that are not working and stopping them takes a lot of self-awareness in the first place, and it takes a lot of courage to come out and say, we're going to turn this off.
But it shouldn't. This is the thing. Like, it shouldn't be this way.
Yeah.
If you spend your marketing dollars, and as you spend them, you get 48 cents in revenue for every dollar that you spend on marketing, which means it costs you 2 years to pay back the marketing costs. Then you add in all the other stuff, and all of a sudden you're at 60 months, 5 years to pay back the cost of acquiring a customer. That there should clearly be an alarm going off in the CFO's office to say something isn't working here. Why isn't that happening? That's what I'm curious about. Like, that should be an immediate flag. Everyone in the executive team should know. And it doesn't have to just be for marketing. It could be for account management. It could be for sales. We need to have the right KPIs that set off the right warning signals that then tell us to go look at attribution.
Yeah.
And then you're looking at attribution with a purpose. And so that's, I think, dividing and thinking differently between the core KPIs that we measure across our go-to-market, which is what we're working on at Paceto, which allows us to forecast, model, plan more accurately, track whether we're on or off track, things like that. And thinking about that differently than attribution, how do we attach channels and investments to try and justify or prove the ROI of those investments, and looking at those as 2 independent concepts, I think would do a lot of good for many leaders who try to mix them into one thing, and try and solve their KPI problem with attribution, and it doesn't work.
Yeah. I mean, absolutely. And I think, one of the many positive side effects, but the one that I really like, is the fact that, following these signals, embracing this data and this way of looking at things produces better buyer-centric marketing that's fun to execute, right? And fun to measure, because it produces results. And it's a much better place to be as a marketer, I think. And it's really therefore what we're recommending all the time, which is, do the things that correlate with the way your buyers buy, that bring the buyer into the pipeline, get them closing, not the things that a platform vendor tells you, confidently you should increase your investment in, or a metric that needs to be improved that's all about the incremental improvement in the measurable but not relevant touch point that's, so misleading. So yeah, complete harmony with the story we're telling our clients and the businesses we talk to about how to do inbound, but in a very demand generation focused way.
Yeah,
love that.
All right. Well, I think we should wrap things up. I've quite enjoyed actually just hearing you two kind of rip off each other. It's been interesting because we often talk about kind of everything you discuss and publish online. So yeah, really, thanks for joining us, Chris. It's been an absolute blast, and I do wish we could talk all day, but we'll be listening to the rest of your content for the rest of the time, probably. So yeah, appreciate you coming on. Thanks for joining us.
Yeah, thanks for having us. Anyone that's on live, if you had a question we weren't able to answer to, feel free to shoot me a DM on LinkedIn in the next 2 hours. I'll answer it on my live show later today. Yeah.
do that.
So feel free if you didn't get your question answered, because we jammed for a long time, which was great. Drop that to me. I'll get it answered and it'll go live on the podcast on Friday.
Awesome. That's why it's the best. All right.
Thanks, y'all.
Catch you
Thanks for
later.
having me.
Thank you,
Catch
Chris.
soon. Bye.
Okay. Bye.